Hello and welcome back to the Money Marketing Podcast. In our last episode, we mapped out the unpredictable macro environment we're all navigating. Today, we're looking at how that translates into structural portfolio design. I'm joined by Andy Fear from M&G to talk about why traditional asset allocation isn't enough anymore and why layering is becoming the new standard in retirement planning. Andy, thank you so much for joining me today.
You're welcome. Yeah, nice to be here with you.
So, Andy, let's clear up the terminology first. What is the fundamental difference between standard asset allocation and what you are calling layering or blending solutions?
Yeah, that's a great question to start us off here. So I think asset allocation is about balancing the risk across one specific portfolio or a portfolio of the client's monies that they've got invested. It's probably about balancing those different asset classes, depending on the client's attitude to risk and the outcome you're trying to achieve from that asset allocation within the portfolio. Layering kind of introduces and is more about assigning roles across the portfolio so that each component is designed for a specific job, a specific role, time horizon, and specific client needs. And especially when we're looking at this from a retirement perspective, which could now be over quite a number of years, those needs are going to be evolving. So it's about building in some flexibility as well to those needs. So really different roles, each component having a specific role and a specific purpose, and about addressing and building that flexibility for the shape of what could be a very long-term, retirement. It's not necessarily about how much risk you take, but more about what the job of each of those portfolios or each of those component parts are doing.
Okay. And why is the traditional one pot, one strategy model increasingly fragile when a client hits the point of actually taking retirement income?
Yeah, well, I think, first of all, we're having to manage that sort of to and through retirement. And that itself, is something that we certainly need to consider. We've very much had a sort of de-risking culture towards retirement, probably in the UK. And that's something we need to think about now with these longer term investment horizons. Certainly if we were investing a client who was in their 30s with maybe 30 years to go, we wouldn't be de-risking them at that with that sort of time horizon. Retirement is not a short, predictable phase anymore. It's about that sort of 30 to 40 year, probably not one event, but a series of events. And really one portfolio, I don't think, can effectively deliver, income and growth and stability and flexibility. Plus what we're seeing over the recent time is, the world is changing. Inflation is a lot stickier as well. And we're seeing that diversification is less reliable, especially from those sort of traditional asset classes. Equities and bonds are not behaving in the way they used to and are not necessarily offsetting each other. And we've seen that very much over recent years. We've got to factor in that we're in a more volatile time, more volatile macroeconomic sort of background. The world is very different. We've got geopolitics, we've got sticky inflation, we've got the great AI, build out. Is that a bubble or is it, a great opportunity for the long term? And then importantly, we've got to build in client behaviors. So a huge part of what we're dealing with here are obviously client behaviors and them coming to and through retirement, big changes in their life. And what we see from a client behavior perspective is that clients have low composure and high impulsivity. So they're going to be irrational, perhaps in some of their decision making, out with what's going on in their life, their purpose, and how they're adapting to retirement. So I think all that needs to be factored in, and a one pot now is very difficult to manage all of those, and especially in the changing market backdrop that we've got.
Yeah. And Going off of that, retirees face a trio of massive risks. Those include sequencing risk, which can be early losses, longevity risks, running out of money, and behavioral risk, like you mentioned, which usually involves panic selling. So, how does a layered approach combining guaranteed income, drawdown, and smooth funds like the PruFund tackle these better than a standard standalone multi-asset fund?
Yeah, absolutely. I mean, risks just don't exist in isolation. So
Mm,
these risks kind of interact and they amplify each other, especially in the early retirement years, but equally over the course of what can be a very long retirement. So in those early retirement years, client sees losses. We're all addicted, aren't we, to our phones, and we're watching the news and we're seeing all the markets and the indices, going red. So with that impulsivity from a client behavior perspective and worry and concern, they might see those losses, panic, sell, that locks in those loss. And that's obviously very bad for that long-term plan. So I guess where layering is trying to help with that behavioral risk as well as as you say, that sort of longevity and sequencing risk. So by layering in, for instance, guaranteed income, perhaps to cover the essentials, maybe that's, you might call that the living money, the heating and the eating. So that is there to try and reduce that anxiety. One of the other things we know with clients, we see a lot of clients, when they die, they've got as much or close to the sort of pot of retirement money that they started off with. So
mm,
that would suggest that they're not living their best retirement and they're not used to spending. They're used to saving. They have an income and they're saving. So actually getting clients used to spending their money, well, some of that guaranteed income actually helps them do that, or some certainty and predictability of that income. And then we can build in, the flexibility with things like drawdown. If we've got 20, 30, 40 years in retirement, the plan will have to adapt. So it's building in that flexibility. So this might be in respect of the discretionary spend, the lifestyle, or maybe we're getting up into luxury. So I don't just want one holiday a year, maybe I want two or three, or some extra weekends away. I want to build in plans to change my car every 3 years, not, every five, etc. And also starting to think through and factor, what's my health going to be like? Do I need to factor in care homes? And also layering and thinking about the estate as well. So we've kind of got the living money, we've got the lifestyle type money, we've got your legacy. All of that needs factoring in. So smooth funds help with that predictability and that consistency. But
mhm,
then over this time period, we're going to need some growth assets. So we need those growth assets to help, obviously, grow the value of the assets and manage maybe some of that longevity and inflation risk. And it's keeping the clients invested over that period of time, which is where the guaranteed money and maybe the smooth fund predictability comes in. So if they're happy that they've got enough guarantee and predictability for their income they need, they'll stay invested with the other growth assets. And finally, I think with this layering concept, it is about aligning to the client needs and objectives, that the advisor as coach can very much help explain the different component parts that the layering is bringing, rather than, the diversification across just one portfolio. So helping the clients to understand the risks to actually try and safeguard the plan.
mhm. And how should advisors approach partitioning a client's wealth by purpose? For instance, matching essential spending with certain structures and discretionary spending with growth engines.
Yeah, absolutely. I mean, I think the advisor as coach is obviously key to this, and a huge role in educating the client. So using that simple, client friendly, framing, rather than obviously the technical lingo that we kind of use from a an investment perspective, or perhaps in financial services. And again, I think advisors are very good at at doing this, sitting in front of their clients and bringing these concepts to life. So in terms of the structure that they might be looking at, was, as I've mentioned, this concept of maybe talking to the client about the living money. So what is the heating, the eating? They're kind of non-negotiable plans for their retirement? How do we shore that up as essential spending? What's then the wider lifestyle that we can start to put in a slightly different strategy for once we've got the essentials covered? So this is the discretionary spending, the experiences the client wants. So if you like, the lifestyle that they're looking to achieve. And again, it's factoring in that adaptability, because that could well change depending on how health goes over that long period of retirement. And then finally, to what part does wanting to pass on a legacy? They might not be interested. The kids can just get on with it. I built the money up. But if they are thinking of that later life and intergenerational wealth transfer, well, what does that mean? So again, talking them through, from the main client's perspective, this is all about the access, the control, and then also looking at the tax, potentially as well. So helping them to understand that, and then building in different layered solutions to meet those different needs. The certainty for the essentials, the flexibility for the lifestyle, and maybe growth assets for that long term, the inflation hedge, or even, that's the intergenerational wealth, maintaining that value over the long period of time. So thinking about client outcomes, thinking about it in client language rather than asset classes, and structuring the portfolios, in that way.
And you talked about volatility a little bit, and I've talked about it with Amy in a previous episode as well. It's just the state of life now. So clients obviously need a portfolio they can actually live with through market dips. How does layering help manage client anxiety and prevent them from making rash decisions during volatility?
Yeah, absolutely. Well, we certainly want clients, don't we, to live their best retirement years. And so helping them understand those risks and not be their own worst enemy, I think is key to this. And behavior risk is probably the biggest risk, particularly around, retirement. Retiring is a huge change, isn't it, for people? A huge change in mindset to get their heads round. They've accumulated this money. They've been used to saving. They've been used to spending out of a predictable income, maybe, from work. So it is a skill of actually changing how they think about, retirement. We know that, a couple who are age 65 at the moment, they've got a 1 in 4 chance of one of them living to 95. That's a long time in retirement. So helping them manage that transition to and through retirement is key. People might have heard of a phrase, the fragile decade, some work by Dan Haylett, who is kind of a retirement specialist from a behavioural aspect as well as a financial planner, and talking about those sort of skills of spending. And where layering, I think, helps with this is, I've said before, bringing in these different roles, these different jobs for what the long-term needs of the client might be, ensuring that they're adaptable. So from a financially sound perspective, ensuring that we've secured those essential income needs. And that, from a behavioral aspect, will help the clients, stay on plan, won't worry so much about the volatility, perhaps, of some of their longer term growth assets. Stops that fear. I mean, smoothing as well, the smooth funds that we obviously promote, they're all about, the aim of those is all about the consistency, the predictability, the peace of mind, not necessarily, chasing, the best possible market return. It is about that consistency, that predictability. And what those two things do from a layering perspective is they help the client stay invested across the whole portfolio. So as I've said, we will definitely need to build in some higher risk growth assets, for longevity, for inflation risk. But the essentials and the smoothing build in, stability. They help with the flexibility, control as well over a long period of time, over a long retirement period. There are going to be legislation changes, policy changes. We're seeing that with pensions, with the new rules coming in from April 27. So again, how does the portfolio adapt to that? And that's where layering in different sort of goals and objectives with a specific portfolio enables us to adapt to those plans. It's not just about the returns. It's about building a plan that the client can stick with over that long period of time. So I think layering turns, a portfolio probably into a lifetime strategy, into a retirement strategy, where each part has its specific job, built for that sort of longer, more complex retirement journeys that we're now seeing people are entering into.
Well, that was all very informative. Andy, thank you for breaking down what true portfolio design looks like today. And for those listening, if you want to explore how PruFund complements other multi-asset solutions, visit the dedicated PruFund web pages. Find out how M&G, the home of retirement, can support your business with the products and tools needed for modern retirement planning. Thank you for being here with me, Andy, and thank you for listening.